Michelle Embling, who is the assurance leader at PwC. She's been a specialist in IFRS since 2004 and has extensive experience advising organisations on complex financial reporting matters, including those relating to financial statements and prospectuses of issuer clients in securities markets. Please welcome Michelle Embling.
Good morning, everybody. I'd like to start off by thanking the FMA for the invitation to speak today, one that I readily accepted actually because the topic of disclosure overload and complexity is one that has been on my mind for quite some time. Firstly as a preparer, then as a standard setter and also as an auditor. And it doesn't really fill me with glee when I look around our office and I see all of our bright young things filling in 100-page checklists. And I wonder if there's something better that they can be doing with their time. So look, I think we all have a job to do, and change we know is difficult. Doing the same thing is actually easy, but change we all know is hard. And it's clear really to me that without guidance from the regulator, there is little incentive for companies to change. So I hope that today's session is a call for change for all of us and to lead change in organisations that we are a part of. So I'm going to bring in an auditor's perspective. We're going to start a little bit with Auditor 101 or Audit 101. So the purpose of an audit is to enhance the degree of confidence of an intended user of the financial statements. The ultimate outcome is the expression of an opinion on those financial statements by the auditor, whether or not those financial statements are presented fairly in all material respects. So in formulating that opinion, the auditor needs to perform sufficient procedures to obtain reasonable assurance that the financial statements as a whole are free from material misstatement. So reasonable assurance is high, but it's not absolute. It's obtained when the auditor has obtained sufficient appropriate audit evidence to reduce the risk to an acceptably low level that they haven't expressed an inappropriate opinion on the financial statements. And in order to form that view, the auditor has to apply materiality, both when planning the audit, but also when conducting it as well. So what does the auditor mean by materiality? Well, quite helpfully, the international accounting standards which apply in New Zealand, and so auditors have to comply with under the Financial Reporting Act, they reference back to the conceptual framework in the underlying reporting framework. So information is material if omitting it or misstating it could influence decisions that users make on the basis of financial information about a reporting entity. So you'll notice a similarity there back to the comments that Kimberly had already made. So that alignment between the auditing standards and the accounting standards in theory should mean that there is no sort of gap or difference of opinion between a preparer's view of materiality and an auditor's view of materiality. I guess, though, if that was the case, we wouldn't be all sitting here today. So there are a range of factors that I believe inhibit both auditors and preparers from having the courage to change and to break free from disclosure overload. We all know that regulator action informs the views of preparers and auditors, and globally we've gone through a period of huge change, and Murray alluded to that earlier. With the fallout of the GFC, there's been a strong response from the audit profession to minimise the risk of regulators flagging concerns around non-disclosure. So the auditor, we see ourselves as really the party that is ultimately reviewed and judged, both internally and externally. The potential repercussions of not managing audit risk effectively can provide an automatic mindset for an auditor that financial statements that are populated with boilerplate and immaterial information and additive disclosures is the lesser of two evils. How many of us around the room have either heard or uttered some of these statements? I was there last year. You've got the information, why not disclose it? The regulators are focusing on this, everyone else does it. You can't take anything out. IFRS says disclose it. Better too much than too little. Or you tell us what to do. So globally, we've seen companies becoming increasingly complex while disclosure requirements have increased. And the increase in those disclosures have been really about the qualitative stuff as opposed to the quantitative information to support the numbers in the financial statements. In the auditor's world, what does this mean? Well, we've seen a huge step change in the requirements and audit methodology. So guidance around sample sizes, what's appropriate, developing materiality and an approach to controls to testing have all become far more prescriptive in our world. We've seen an increasing use of technology through the development of more sophisticated auditing software, tailored procedures and a consistent global approach taken by the large firms. And in many ways, those approaches taken by the global firms and that permutate down here into New Zealand, they are impacted and shaped by the views of the regulators around the globe. It has come at a cost, I think, because we've talked about the need for auditors to apply judgment, in fact, for all of us to apply judgment. And that judgment involves weighing up on one hand for an auditor the training that they've received, the knowledge and the experience and the context of the client, and weighing that up against the auditing standards. I think we now have a generation of preparers and also auditors who have come through the ranks learning how to fill in checklists and tick boxes, right? So if I think back to when I was a bright young thing, it's only a few years ago, we didn't have IFRS, we had some local standards, I think there might have been 8, and often we got into the debates in the room around, well, what is this transaction? What is it really doing? We understood it, the commercial aspects for it, and then we thought about, based on first principles, what do we disclose? How do we disclose it in a way that is meaningful? A lot of that thinking has actually been edged out of our newer members of our profession, if I can put it that way. You combine that in a New Zealand context. Now, our finance teams run lean and mean. And that might be great from an efficiency point of view, but when you're starting to look about changing things into financial reporting or even year-end processes, those teams are probably too lean and mean to take the time to step back and reflect. So I think that is another thing that we have to deal with in a New Zealand context. So what do we need to change? Well, if you go back to the initial definition of materiality, everything hinges on understanding what a user needs. I thought I might just reflect on what the user from the perspective of the auditing standards, because I think this is interesting. So this is what in the international standards of auditing they think are the attributes of a user of the financial statements. So they have a reasonable knowledge of business and economic activities and accounting. They have a willingness to study the information in the financial statements with reasonable diligence. They understand that financial statements are prepared, presented and audited to levels of materiality. They recognise the uncertainties inherent in the measurement of amounts based upon the use of estimates, judgment and the consideration of future events. And they make reasonable economic decisions on the basis of information in the financial statements. Doesn't sound like a typical mum and dad investor. Well, it's not my parents. And I look through that and I think, actually, is that me as well? Because whilst I might have the underlying technical knowledge and understanding, do I really spend the time going through the financial statements of companies that I intend to invest in? And the reality is I'm time deprived, so I don't. So I think that's quite a high hurdle in terms of thinking about who are the users. But the view of the user is paramount because you have to understand who the user is in order to form a view of what is material and what is not material to their decision making, because that's where you start to form your views as a preparer and as an auditor to what goes in, what to elevate and what to leave out. So I think it's an ongoing journey. I think it's been already alluded to today, but there are a number of stakeholders who all have a really important role to play in this process, and I believe that most of those groups are there. I think clear leadership from the directors and the C-suite in an organisation is really important to effect change. And it doesn't matter what that change is in an organisation, but you can't do this from the bottom up. It has to be led from the front. You have to have a view of who your users are and what information that they are going to use to make judgments. There has to be upfront discussion, and there has to be good documentation and an articulation around that as well. And then an ongoing process of evaluation. There are some changes as well coming through the auditing standards to sort of mirror what's been done at the IASB level, to actually provide some more guidance to auditors in this area as well. Whilst that's still in the formative stage, there's nothing stopping us as an auditing profession to start following some of these things now, because at their essence, it is common sense, but as we know, sometimes common sense is not that common. Now, it's all very well for me to stand up here and say you should do this and you should do that. What I have done back at PwC is challenged our team to start thinking about how can we do things differently and how can we show the way. So we have reorganised the information to make it easier to find and to tell the story more. We have actually included some additional information up front so that you could understand what has been important in the context of that company for the year, what are the key changes that have driven it, and included a net debt reconciliation. We've done a lot of colour coding, put in a lot of tables, and grouped like items together. So we put all of the financial asset information together, including accounting policies and others. So that's up on our website. Play around with it, but please, 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 please don't use it as a template. Just play with it. So in summary, the definition of materiality from both an accounts preparation and an auditing perspective are the same. Both take a user's viewpoint, so you have to form a view of who your users are. It's tricky and it requires you to exercise professional judgment. All of us in the financial reporting chain must be prepared to work together and collaboratively to make the change and to improve financial reporting. We have to be courageous and brave, and we need the support of our regulator and understanding of our regulator. Thank you very much. But essentially, for any change to occur, it requires leadership, and I'm pleased that we have so many leaders in this room. So please, if you do nothing else today, take up the mantle and go back and change something. Thank you.